I just want to talk about how the strength or weakness of the dollar or another local currency influences gold prices. Um, but first, I'm going to talk about the dollar. So, the price of gold is generally inversely related to the value of the US dollar. And why is that? Well, gold on many international markets, in many international exchanges, is denominated in US dollars. And so, if the value of the dollar decreased, it would take more dollars to buy an ounce of gold compared to another currency. In other words, it would be cheaper to buy gold using a currency other than the dollar. Now, this other currency could be a rival currency, like the euro, like the Japanese yen, or the British pound sterling, or something else. But more than that, a decrease in the value of the dollar might be seen as a sign of inflation. And since gold is a hedge against inflation, any hint of increased inflation will translate into increased gold demand. And a weakening dollar could also be a sign that there is economic contraction happening in the US for whatever reason. And of course, since gold is a hedge against geopolitical risk, market turbulence, basically anything negative in the economy, then a lot of investors divert capital into something safe, into a safe asset such as gold, and therefore demand for gold increases, and that subsequently translates into increased gold prices. And so in aggregate, as the dollar or any other local currency becomes weaker or devalued, the higher the gold price gets. Conversely, as the dollar or the local currency gains strength, the lower the gold price gets. So I've got a couple of charts here as examples of this relationship, which is negative in nature, a negative correlation. You can see here the blue line represents the dollar index, and the orange line represents gold price. So we can clearly see that there is a negative relationship as one increases, let's say the dollar, as the dollar increases, gold price decreases, and when gold price increases, the dollar decreases. So very clear negative relationship all around. We can see the same thing in other currencies. So Turkish lira and gold, euro and gold, same thing. Japanese yen and gold, again, negative relationship. Now I did find an exception to this rule, this correlation. And this exception occurs between gold and Australian dollar and US dollar currency pairing. We can see that there is a positive relationship between the two variables. As gold increases, AUD and USD also increases. Now, what could be the reason behind that? Like, why is this happening? Well, here is the thing. Australia is the second biggest gold producer or gold mining nation in the world, so it's quite an important part of their economy. Additionally, Australia exports a lot of gold around the world, and so they are big players in the gold market, and especially in the Asian gold market. And obviously exports in economics are a capital inflow into an economy. And because they're selling a lot of gold, that means there's a lot of capital inflow occurring into their economy, which makes their economy good. And since currencies, since a good economy, since a good currency depends on a good economy, because of that link, as more gold is sold by Australia, the stronger their economy gets, and indirectly the stronger their currency, the Australian dollar, gets. So this is the reason why there is a positive relationship between Australian dollar and gold. A lot of experts talk about the coefficient between the US Australian dollar and gold being around 0.77, which is quite a strong positive relationship. Segueing into another point, I created this model to support this theory, this correlation that I mentioned earlier. So we can, on this example, let's say the price for 1 ounce gold bar is $1,000, and let's say that the central bank of a country, could be the Fed, could be another central bank, doesn't matter. Let's say they increase the money supply. Let's say they double the currency supply in the economy, and because of that, that should make the price of 1 ounce gold bar double as well, so it should become $2,000. But what's actually happening here? So it's important to note that I am isolating so supply and demand forces out of this equation. I'm looking at purely monetary economic theory here. So over here on the left side, we can see that there is 4 currency units chasing 1 ounce gold bar, and obviously these currency units represent all of the money supply circulating in the economy. And when the central bank doubles it, we can see that there's 8 currency units chasing the 1 ounce gold bar. So what has happened here is that the price of gold did not increase in value. There is nothing that occurred to the 1 ounce gold bar. The 1 ounce gold bar is the same. Its value is the same. But what has actually happened is that the currency you buy the 1 ounce gold bar with has decreased in value. It has become devalued. It has become weaker. It has lost its purchasing power by half. So if the currency loses its purchasing power by half, you're obviously going to need double the amount of that currency to buy the same thing. And this is the reason why there is a negative relationship in general across the board, all over the world, between currencies and gold. And you could apply this model to any currency really, except the Australian dollar and some other large gold exporting countries.